Yesterday morning, silver traders watching their screens witnessed something that shouldn't be possible in a functioning market. The price crashed from a record $84 per ounce down to 73, or 72, in a matter of hours, the largest single-day collapse in over 5 years. The Chicago Mercantile Exchange had just raised margin requirements by 13.6%, forcing leveraged traders to liquidate positions in panic. But here's what makes this moment extraordinary. While American futures contracts were imploding, physical silver in Shanghai closed the same day at $78.49 per ounce, with Chinese buyers paying an additional $8 premium on top of that price. Think about what that means. On December 29, 2025, the same ounce of silver traded at two fundamentally different prices depending on whether you wanted a paper contract or actual metal in your hands. This isn't a temporary arbitrage opportunity. This is evidence of a market splitting in two right before our eyes. We're watching the early stages of a delivery crisis that most Americans don't yet understand. The financial instruments we've trusted to track silver prices, the futures contracts traded on COMEX, the exchange-traded funds in our retirement accounts, are showing prices that no longer reflect what physical metal actually costs in the real world, and the gap is widening. The question isn't whether you own silver or care about precious metals. The question is whether you understand what happens when the paper promises backing a significant portion of our financial system start disconnecting from physical reality. Because silver isn't just a metal collectors hoard in safes. It's essential to solar panels, electronics, medical equipment, and military technology. When the pricing mechanism for a critical industrial commodity breaks down, the consequences ripple far beyond one market. Let me show you exactly how we got here, and why the next few months are going to test whether our Western financial markets can maintain credibility. The warning signs have been flashing for weeks, but most financial media keeps reporting silver prices as if nothing has changed. Pull up any major financial website right now, and you will see a single price for silver, probably somewhere in the mid-70s per ounce. That number comes from COMEX futures contracts, paper agreements to deliver silver at a future date. It's the price that funds your silver ETFs that analysts reference in their reports, that investors use to make decisions about precious metals exposure. But if you actually tried to buy physical silver in bulk right now, not a few coins from a dealer but serious commercial quantities, you discover that Shanghai price I mentioned. According to the Shanghai Gold Exchange, physical silver closed December 24th at $78.49 per ounce, with buyers routinely paying $8 above that for immediate delivery. These aren't panicked retail investors overpaying. These are sophisticated commercial buyers, refiners, and manufacturers in the world's largest silver market, paying real money for real metal. That $8 premium tells you everything about supply stress. When buyers compete this aggressively for immediate physical delivery, it signals that waiting for future delivery isn't an option they trust anymore. They need the metal now, and they're willing to pay significantly above the futures price to guarantee they actually receive it. The divergence isn't just happening in China. Our own system is showing cracks that should alarm anyone paying attention. The Bank of England, the institution that stores much of London's physical precious metals, now requires 4 to 8 weeks for silver deliveries that used to take 48 hours. Let that sink in. The vault system that has facilitated instant precious metal settlement for generations now needs up to 2 months to locate and deliver metal. On January 29, 2025, Bank of England Governor Andrew Bailey faced questioning from the UK Treasury Committee about these systemic vault risks. His testimony was remarkably evasive, acknowledging delays without explaining why one of the world's premier financial institutions suddenly can't fulfill basic storage and delivery functions. When a central bank governor can't clearly explain why vault operations are failing, it's time to ask harder questions about what's really happening behind those vault doors. Here's where the story gets even more concerning for American investors. Yesterday's margin requirement increase wasn't just routine risk management by the CME. Raising margin requirements to $25,000 per contract forces traders to post significantly more collateral, which triggers automatic liquidations when accounts can't meet the new threshold. And the exchange knew this would crash the futures price. They did it anyway. Why would the exchange that profits from silver trading volume deliberately trigger a crash that scared away participants? Either they're seeing risks in the market that require immediate deleveraging, or they're trying to shake out smaller traders before something bigger unfolds. Neither explanation is comforting. The flash crash accomplished exactly what you'd expect. Paper silver prices plunged while physical premiums stayed elevated. If you're an investor holding silver ETFs or futures contracts, you watched your positions lose value yesterday. But if you're a commercial buyer in Asia holding physical metal, your inventory became more valuable as the discount between paper prices and physical reality widened. This is the two-tier market forming in real-time. Financial instruments that promise silver delivery trade at one price. Physical silver that actually exists in vaults and can be delivered immediately trades at another price. And every day that gap persists, it raises fundamental questions about whether all those paper promises can actually be fulfilled. Think about your retirement account for a moment. If you hold a silver ETF, you own shares in a fund that's supposed to track the silver price. The fund's prospectus promises that each share represents a certain amount of silver stored in a vault somewhere. But what happens if the vault can't deliver that silver in a reasonable time frame? What happens if the fund has to pay Shanghai prices to acquire physical metal while the shares trade at COMEX prices? That gap comes out of someone's returns, and that someone is likely you. We've seen this pattern before in other commodities when paper markets disconnect from physical reality. The resolution is never gentle. Someone holding promises that can't be fulfilled discovers those promises weren't worth what they thought. Someone expecting delivery finds out the metal isn't actually there. Someone trusts the price on their screen only to discover they can't transact at that price when it matters. The difference with silver is scale and essentiality. This isn't a niche commodity with few industrial uses. This is a metal critical to the technologies our economy depends on, from renewable energy to consumer electronics to defense systems. When the pricing mechanism for critical industrial inputs breaks down, it doesn't just hurt speculators and investors. It creates uncertainty throughout supply chains that depend on reliable pricing to make production decisions. And we're just beginning to see what happens when Eastern and Western silver markets operate on fundamentally different terms. Let me show you the data that proves this isn't speculation or theory. The evidence is sitting in official exchange reports, vault statistics, and delivery records that anyone can verify. What you're about to see explains why those Shanghai premiums exist, and why London vaults suddenly need 2 months to deliver metal they're supposed to have on hand. Start with the COMEX warehouse reports, the official inventory numbers published by the exchange where American silver futures trade. In 2020, COMEX vaults held 346 million ounces of registered silver. That's metal available for delivery against futures contracts. As of late November 2025, that number had collapsed to approximately 113 million ounces. That's a 70% decline in the physical silver backing our largest futures market. But here's where it gets truly alarming. In just the first 4 trading days of December 2025, over 60% of that remaining registered inventory, 47.6 million ounces, was claimed for delivery. Think about the mathematics of that moment. In less than a week, commercial buyers demanded delivery of more than half the metal that's supposed to back the entire American silver futures market. That's not normal market behavior. That's a run on the vault. When sophisticated commercial players suddenly demand physical delivery instead of rolling their futures contracts forward, they're telling you something important. They're saying they don't trust the paper promises anymore. They want metal in hand, in their own vaults, under their own control. And when 60% of available inventory gets claimed in 4 days, it raises an obvious question. What happens to the people holding contracts for the other 40% if they also decide they want delivery? The exchange has mechanisms to handle this, of course. They can issue more warehouse receipts. They can incentivize holders of physical silver to register their metal for delivery. They can raise margin requirements to discourage delivery demands, which is exactly what they did yesterday. But each of these responses has limits, and we're starting to test those limits in ways that haven't happened in decades. Now shift your attention across the Atlantic to London, where the other major silver trading hub operates. In October 2025, the London vault system faced a crisis severe enough that it required emergency imports of 53.88 million ounces from New York, Shanghai, and other international sources. That's roughly half of what COMEX currently holds in registered inventory, emergency airlifted and shipped into London vaults to prevent delivery defaults. According to multiple reports from that period, J.P. Morgan, one of the largest precious metals dealers in the world, told major Indian clients in mid-October that we don't have any silver to send. Let that statement settle for a moment. J.P. Morgan Chase, a financial institution with over $3 trillion in assets, couldn't locate silver to fulfill client orders. This wasn't a small retail customer trying to buy a few coins. These were major Indian clients, likely bullion dealers and manufacturers, being told that one of the world's premier banks had no silver available. The October crisis forced vault operators to scramble for metal from wherever they could find it. New York vaults sent silver across the Atlantic. Shanghai released metal for international delivery despite Chinese buyers wanting every ounce they could acquire. Other international sources contributed to the emergency stockpile. And somehow, London patched together enough metal to avoid outright delivery failures that would have exposed the system's fragility to the entire market. But emergency measures aren't solutions, they're delays. They buy time without addressing the fundamental problem. Global silver demand is exceeding available supply, and the vault system wasn't designed to handle this level of physical delivery pressure. Here's why the London crisis matters for American investors. Our silver markets aren't isolated systems. When London vaults run short, they pull metal from New York. When Shanghai offers higher prices, metal flows east instead of west. When J.P. Morgan tells clients they have no silver available, it means the interconnected global vault system is stretched thin across all major trading hubs. Your silver ETF might hold shares supposedly backed by metal in a London or New York vault. But what happens when those vaults are shipping metal overseas to prevent defaults elsewhere? The market structure itself reveals the stress. Silver has entered what traders call persistent backwardation, meaning near-term futures. Contracts are trading at higher prices than long-term contracts. In a normal commodity market, future delivery should cost more than immediate delivery because of storage costs, insurance, and the time value of money. When that relationship inverts, when immediate delivery costs more than future delivery, it signals extreme physical demand and supply stress. During the most acute stress periods, silver lease rates have spiked to 200% annualized. That's the interest rate someone pays to borrow physical silver for a short period. When lease rates reach 200%, it means the demand to borrow physical metal is so intense that borrowers will pay double the metal's value in annual interest just to access it for a few months. That's not speculative behavior. That's industrial users and commercial dealers desperate for physical supply to fulfill existing obligations. Think about what backwardation and exploding lease rates actually mean in practical terms. Somewhere in the global supply chain, manufacturers need silver to build solar panels, electronics, medical equipment. They have contracts with customers, production schedules, workers waiting for materials. When they can't access silver at reasonable prices through normal channels, they start bidding aggressively for immediate supply. They pay premiums. They accept backwardation. They borrow at 200% rates, because not having the metal means shutting down production lines and defaulting on customer contracts. The desperation we're seeing in lease rates and backwardation isn't coming from investors trying to make money on price swings. It's coming from commercial users who need physical silver to maintain operations. And when industrial users start outbidding financial traders for physical metal, it tells you the market has shifted from normal trading activity to genuine scarcity. Now connect these data points. COMEX inventory down 70%, with 60% of what remains claimed in 4 days. London requiring emergency imports of 54 million ounces to avoid defaults. JP Morgan unable to source metal for major clients. Persistent backwardation and lease rates at 200%. Shanghai premiums at $8 per ounce above futures prices. Bank of England delivery delays stretched from 48 hours to 2 months. This isn't a collection of isolated incidents. This is a system under coordinated stress across every major trading hub simultaneously, and the common thread running through all of it is the same. Physical silver is becoming difficult to source in commercial quantities at the prices reflected in futures markets. You might wonder why exchanges and vault operators don't just increase the price until supply and demand balance naturally. That's how markets are supposed to work, after all. But here's the complication. Futures markets exist partially to provide price stability for commercial users. Manufacturers' budget for silver costs months in advance based on futures prices. If COMEX silver suddenly jumped to match Shanghai physical prices, it would invalidate thousands of existing contracts, force massive margin calls, and create chaos throughout industrial supply chains that depend on reliable pricing. The exchanges are caught between two impossible choices: keep futures prices suppressed through margin requirement increases and other technical measures, which maintains the appearance of stability but widens the gap with physical reality, or let futures prices rise to match physical demand, which triggers immediate financial chaos, but eventually rebalances supply and demand at honest price levels. Yesterday's margin requirement increase shows which path they've chosen. They're trying to maintain the paper price by discouraging delivery demands and forcing leveraged traders to liquidate positions. It's a delaying tactic, not a solution, because every day that COMEX prices stay disconnected from Shanghai prices, the incentive grows stronger for anyone holding futures contracts to demand physical delivery, and then immediately sell that metal into Asian markets at the higher price. That arbitrage opportunity, buying COMEX, taking delivery, selling to Shanghai should theoretically close the price gap quickly, but it's not happening at scale because of those delivery delays and vault stress we've been discussing. You can't arbitrage a price differential if you can't actually get the metal delivered in a reasonable time frame. So the two-tier market persists, with paper prices in the West and physical prices in the East continuing to diverge. For American investors, this creates a genuinely uncomfortable situation. If you own paper silver in any form, ETFs, futures contracts, mining stock exposure, you're betting that the Western paper market will eventually converge with Eastern physical prices by moving up. But there's another possibility. The paper market maintains artificially suppressed prices through technical measures, while physical premiums continue rising, meaning your paper claims become worth less relative to actual metal. That's not a conspiracy theory. That's exactly what the pricing data from the last several months is showing. Now, let me show you the mathematics that make this situation unsustainable. The numbers I'm about to share aren't projections or estimates. They're documented deficits, verified inventory levels, and contractual obligations that exist right now in exchange records. When you understand the scale of the imbalance, you'll see why the next few months are going to force a resolution one way or another. According to the Silver Institute, global silver markets have been running supply deficits for 7 consecutive years. From 2021 through 2025, the accumulated deficit reached 800 million ounces. That's equivalent to an entire year of global production simply absorbed into demand without being replaced by new supply. For 2025 alone, the Silver Institute projects a deficit of 149 million ounces, meaning demand exceeded supply by roughly 15% for the year. Think about what 7 years of deficits does to above-ground inventory. Every year, industrial users consume more silver than mines produce. Every year, that deficit gets filled by drawing down existing stockpiles from vaults, government reserves, and recycled sources. Eventually, you run out of stockpiles to draw from, And that is when the price adjustment becomes unavoidable because physical scarcity can't be resolved through financial engineering. We're seeing evidence that we've reached that inflection point. Those COMEX inventory numbers I mentioned, down 70% since 2020, that is physical proof of 7 years of deficits finally exhausting available supply. The London emergency imports in October. That's what happens when traditional sources of buffer inventory dry up, and even major financial institutions can't quickly source metal to meet obligations. But here's where the mathematics become truly problematic for anyone holding paper silver claims. Recent analysis shows COMEX open interest at 244% of vaulted silver. Let me translate that clearly. The total number of futures contracts promising silver delivery exceeds the amount of physical silver in COMEX vaults by a factor of 2.4 times. For every ounce of metal available for delivery, there are 2.4 paper claims on that same ounce. Now, this is normal to some degree in futures markets. Not everyone demands delivery. Most traders close positions before contract expiration. The system functions as long as only a small percentage actually wants physical metal. But what happens when that percentage increases from the traditional 1 or 2% to something higher? What happens when commercial buyers start demanding delivery at the rate we saw in early December? 60% of registered inventory claimed in 4 days. Do the math with me. If just 2% of open interest demands delivery right now, COMEX registered inventory cannot satisfy those claims. The metal isn't there, and we've already seen delivery demands running far higher than 2% during peak stress periods. The system is operating with no margin for error, no buffer capacity for unexpected delivery demands, no cushion if commercial users suddenly decide they want physical metal instead of paper contracts. This fragility exists during a period when China controls 70% of global silver refining capacity. Think about the strategic implications of that concentration. Most of the world's raw silver gets processed through Chinese refineries before entering finished product markets. If Chinese policy prioritizes domestic industrial needs over international supply, or if export restrictions tighten further, Western markets lose access to the majority of refined silver production. We've already seen hints of this dynamic. Those Shanghai premiums aren't just reflecting local demand. They're reflecting the reality that Chinese buyers have first access to domestically refined metal, while international buyers compete for whatever remains available for export. As China's solar panel production, electronics manufacturing, and technology sector continue expanding, domestic silver consumption keeps rising, which means less available for export regardless of official policy. The technical analysis adds another layer of concern to these fundamentals. Multiple market analysts are projecting silver prices in the $90 to $100 per ounce range for Q1 2026, just a few months from now. Their reasoning combines the supply deficit, the vault stress, the persistent backwardation, and the widening gap between paper and physical prices. Some analysts describe a likely pattern of a double bottom retest around $70 per ounce followed by a renewed push toward $100 as the two-tier market becomes permanent. That phrase, permanent bifurcation, should grab your attention. Analysts aren't talking about a temporary price dislocation that resolves quickly. They're describing a structural split where Chinese domestic prices, what some are calling the China sponge price, remain stable and internally controlled while international prices, the world price, become scarcity-driven and volatile as non-Chinese buyers compete for limited remaining supply. If that bifurcation happens, it fundamentally changes how silver markets function. Instead of one global price with minor regional variations, we'd have separate price regimes for different geographic markets. Your silver ETF, your COMEX futures, your mining stock exposure, all of these would trade based on Western market prices that might be persistently lower than the prices at which physical silver actually trades in the world's largest consumption market. That's the two-tier system becoming permanent, and it's what yesterday's margin increase and flash crash might be accelerating rather than preventing. Let me put this in terms that connect to your personal financial situation. If you're saving for retirement, you probably hold some precious metals exposure for diversification and inflation protection. Maybe that's a silver ETF in your 401k. Maybe it's actual coins in a safe. Maybe it's mining stocks. The question you need to ask is whether your silver exposure gives you actual access to physical metal or just paper claims that might not be deliverable when you need them. If you hold an ETF, look carefully at the prospectus language about how the fund sources metal and handles redemptions. Does the fund hold physical silver in allocated vaults where specific bars are segregated and identified? Or does it hold unallocated positions where you have a general claim on a pool of metal? If delivery stress continues escalating, those distinctions matter enormously. Allocated physical holdings maintain value. Unallocated claims that can't be fulfilled become worth whatever distress settlement the fund negotiates. If you hold futures contracts thinking you can demand delivery if needed, understand that COMEX has force majeure provisions allowing cash settlement if they can't deliver physical metal. During extreme stress, the exchange can simply pay you the contract value in dollars rather than delivering silver. You might lock in a price of $75 per ounce, demand delivery, and receive $75 cash while physical silver is trading at $95 in Shanghai. The contract protected you from downside risk, but not from the upside opportunity cost of holding paper instead of physical metal. If you hold mining stocks, recognize that miners benefit from rising silver prices regardless of whether those prices reflect paper or physical markets. Their revenue comes from selling physical production. So if Shanghai prices keep climbing while COMEX prices stay suppressed, miners can increasingly direct sales toward Asian markets at premium prices. In that scenario, mining stocks might outperform silver ETFs because the miners capture the higher physical prices while ETFs stay tied to lower paper prices. For Americans trying to protect purchasing power and build wealth, this two-tier market creates both risks and opportunities. The risk is holding paper silver that doesn't give you actual exposure to physical price movements. The opportunity is understanding that physical silver, if you can acquire it at anything close to current COMEX prices, gives you access to a market where premiums keep expanding and demand keeps overwhelming supply. But there's a broader implication here beyond personal investment decisions. When critical industrial commodity markets start splitting between paper and physical prices, it signals deeper problems in how our financial system functions. Silver isn't unique. We've seen similar dynamics in other metals, in energy markets, in agricultural commodities. Every time paper markets disconnect from physical reality, it erodes confidence in the financial infrastructure that's supposed to facilitate efficient price discovery and resource allocation. The Chinese understand this, which is why they've been methodically building parallel financial infrastructure over the past decade. The Shanghai Gold Exchange, the Belt and Road Initiative bilateral trade agreements settled in yuan rather than dollars, these aren't random policy choices. They're pieces of a coordinated strategy to create alternatives to Western financial markets and institutions. The silver market bifurcation we are witnessing is one example of what happens when that alternative infrastructure reaches sufficient scale to operate independently. For our economy, for our financial markets, for our position in the global system, the splitting of commodity markets into separate Eastern and Western price regimes is a warning signal worth heeding. It suggests that the dominance our financial institutions have enjoyed since World War II is eroding in practical, measurable ways. When Shanghai prices become the reference point for physical silver instead of COMEX prices, it means Chinese markets are setting the real price while our markets trade derivative instruments that may or may not reflect underlying value. The timeline for resolution is compressing. Those Q1 2026 price targets from analysts, $90 to $100 per ounce, are just weeks away. The delivery pressures that drained 60% of COMEX registered inventory in 4 days haven't resolved. They've just been temporarily suppressed through margin increases. The London vault system that required emergency imports in October hasn't rebuilt substantial buffer inventory. The 7-year supply deficit continues with no indication that 2026 production will suddenly reverse the trend. Something has to give. Either paper prices rise dramatically to match physical reality and choke off speculative demand, or physical premiums keep expanding until paper markets become irrelevant to anyone actually needing metal. Either Western vault systems rebuild inventory levels sufficient to handle delivery demands, or they implement increasingly draconian measures to prevent physical settlement of contracts. Either the two-tier market resolves through convergence, or it becomes a permanent feature that reshapes how global commodity trading functions. For those of us watching these developments as Americans concerned about our financial system, its credibility, and our economy's functionality, the silver market situation is a test case. It is showing us in real time what happens when 7 years of supply deficits meet a concentrated global supply chain, paper markets with insufficient physical backing, and geopolitical competition between Eastern and Western financial systems. You don't need to panic. You don't need to make rash investment decisions based on fear. But you do need to understand what's actually happening in these markets so you can make informed choices about your financial future. The silver market is teaching us an important lesson about the difference between owning financial claims and owning physical assets, about the risks of concentrated supply chains, about what happens when paper promises exceed deliverable reality. Pay attention to what happens over the next few months as we move into Q1 2026. Watch whether COMEX prices start climbing toward those analyst targets, or whether exchanges implement more aggressive measures to suppress delivery demands. Watch whether Shanghai premiums narrow or continue widening. Watch whether vault delivery times improve or deteriorate further. The data will tell you whether this crisis is resolving or accelerating. And remember that the warning signs are already visible in the official numbers, the vault records, the delivery delays, and the premium structure. This isn't speculation about what might happen. This is observation of what's already happening, documented in exchange data that anyone can verify. The question isn't whether there's stress in silver markets. The question is whether that stress leads to an honest price adjustment or a system breakdown. Either way, understanding the mechanics of this two-tier market gives you the awareness to navigate whatever comes next. And that awareness, that ability to see what's really happening behind the official narratives and reported prices, that's the real edge in uncertain times.